One quiet Sunday night, August 15th, 1971, a man in a suit sat at a desk and told the world a story that would outlive him. It was not the language of conquest. It was not the sound of tanks. It was a television address, a few measured sentences, and a single word that did the real work. Temporarily. President Richard Nixon announced he had directed his Treasury Secretary to suspend the dollar's convertibility into gold. In plain terms, the United States had just closed the gold window. The world's most trusted receipt for value was no longer redeemable for the thing it promised. Most people did not panic. Stores opened the next morning. Paychecks still cleared. The papers still looked the same, but something foundational had shifted. Money stopped being a claim on reality and became a claim on authority. Until that night, the post-war system built at Bretton Woods had offered a simple anchor. Foreign governments could exchange dollars for gold at $35 per ounce. Other major currencies were tied to the dollar, and the dollar was tied to gold. Scarcity imposed discipline. When you could run to the metal, promises had a hard edge. Here's the uncomfortable thought that sits behind this whole story. Bretton Woods did not fail because the world stopped loving stability. It failed because stability is expensive. The anchor only works when the country issuing the world's reserve currency can resist the temptation to create more claims than it can honor. And by the late 1960s, the arithmetic was straining under the weight of empire, global commitments, and domestic politics. The system depended on trust, but the system also quietly manufactured doubt. Nixon's announcement is often remembered as an economic policy move. But if you watch it the way power watches it, it looks like something else. A switch in the operating system of civilization. A transition from money backed by a scarce asset to money backed by faith in institutions. A move from restraint to flexibility. From limits that existed outside politics to limits negotiated inside politics. That night did not merely change exchange rates. It changed human behavior. Because when money is no longer bound to something you cannot print, the entire map of incentives redraws itself. Governments learn a new reflex. Banks learn a new language. Markets learn a new theology. And ordinary people, without realizing it, begin living inside a story where numbers can grow faster than productivity, where debt can expand faster than income, and where the definition of value becomes whatever the system needs it to be to survive one more cycle. So when we say the night money lost its meaning, we are not being poetic. We are describing the moment the modern world chose a different kind of reality. To understand why that Sunday night mattered, you have to step behind the speech and into the machinery that made it inevitable. Bretton Woods was never just a currency arrangement. It was a political bargain disguised as a technical system. After World War II, the United States emerged, with the world's largest gold reserves, intact industry, and unmatched credibility. The deal was simple and brilliant. America would anchor the system with gold, and in return, the world would anchor itself to the dollar. Stability would flow outward from Washington. For a generation, it worked because incentives aligned. Europe needed reconstruction. Japan needed access to trade. The dollar became the lubricant of global recovery. But here is the hidden structure most people miss. The system assumed a frozen moment in history, that the United States would remain both the world's banker and the world's most disciplined actor. That assumption quietly broke as America's role expanded from economic leader to global manager. Dollars did not just circulate domestically. They accumulated abroad. Central banks, exporters, and governments held growing piles of U.S. currency as reserves. These eurodollars, as they were called, were claims on American gold that sat outside American control. Every new overseas commitment, every foreign base, every war funded without corresponding taxes, added more claims to the system. The gold stayed still. The promises multiplied. This is where the structure began to bend. The United States faced a dilemma no empire escapes. If it tightened policy to defend gold, it risked recession at home and political backlash. If it loosened policy to fund growth and power, it risked draining gold reserves, as foreign holders called in their claims. Discipline and dominance were pulling in opposite directions. By the late 1960s, the contradiction was no longer theoretical. Foreign governments did the math. The total number of dollars outstanding exceeded the gold available to redeem them. Trust did not collapse overnight, but it thinned. And once trust becomes conditional, systems like Bretton Woods cannot survive. What Nixon announced in 1971 was not a sudden betrayal. It was the formal recognition that the old structure had already failed. The speech did not kill the system. It admitted that the system had been running on borrowed credibility for years. Closing the gold window was not an act of confidence. It was an act of containment, designed to stop a slow-motion run before it turned into a visible panic. Seen this way, the night money lost its meaning was not about gold itself. It was about the moment power chose flexibility over restraint, about the moment political necessity overruled mechanical limits, and once that choice is made, it never really gets reversed. Once the gold window closed, the world crossed a line it could not step back over. The promise that had restrained governments for centuries was gone, replaced by something far more abstract: discretion. From that moment on, money was no longer limited by what could be dug from the ground or accumulated in vaults. It was limited only by what policymakers believed the public would tolerate. At first, the consequences seemed mild. Exchange rates were allowed to float. Economists spoke confidently about flexibility and adjustment. In theory, currencies would find their true value in open markets. In practice, something else happened. Without a hard anchor, price stability became a political goal rather than a mechanical outcome. And political goals shift. The 1970s delivered the first lesson. Inflation surged across the developed world, not as an accident, but as a delayed response. Wages chased prices. Prices chased energy shocks. Savings quietly lost purchasing power. For ordinary households, money began to feel unreliable. A dollar no longer promised the same future a dollar saved once had. But for governments, the new system offered something intoxicating: time. Deficits no longer required immediate sacrifice. Wars could be financed without raising taxes. Social programs could expand without confronting voters with their full cost. Debt became a bridge to the future, one that could always be rolled over. Each crisis could be met with more spending, more credit, more monetary accommodation. The discipline that once forced hard choices had been replaced by narrative management. This was the real turning point. Not inflation itself, but the normalization of postponement. Every imbalance could be deferred. Every cost could be socialized across time. The pain did not disappear. It simply became less visible, spread thinly through higher prices, asset booms, and widening inequality. Markets adapted faster than societies. Finance learned how to thrive in a world of expanding credit. Leverage became a feature, not a flaw. Asset prices began to rise faster than wages. Those who owned assets benefited from the system's elasticity. Those who depended on fixed incomes or savings paid the hidden bill. The meaning of money diverged depending on where you stood. By the 1980s, the language had changed. No one spoke seriously about returning to gold. The new order had found its logic. Money was a tool of management, not a mirror of value. Stability was something to be engineered, not guaranteed. And once money becomes a policy variable, the question is no longer whether it will be used, but how aggressively. The turning point of 1971 was not just about abandoning gold. It was about accepting a world where limits could be negotiated, postponed, and redefined. And from that moment on, the system began rewarding those who understood the new rules, while quietly punishing those who still believed money meant what it used to mean. When money is no longer anchored to something scarce, control shifts from geology to governance. The question stops being how much gold exists and becomes who decides how much money should exist. This is where fiat currency reveals its true function, not as a neutral medium of exchange, but as an instrument of coordination and power. Central banks moved to the center of the system. Interest rates replaced gold as the primary lever of discipline. By raising rates, authorities could slow borrowing, cool inflation, and signal restraint. By lowering them, they could encourage risk, stimulate growth, and rescue markets. On paper, this looked like progress. Human judgment replacing metal, flexibility replacing rigidity. But discretion always carries asymmetry. Those closest to the source of money feel its effects first. Governments spend before prices adjust. Financial institutions access liquidity before wages rise. Asset markets respond faster than labor markets. This sequence, often invisible, systematically favors borrowers over savers, institutions over households, and asset owners over wage earners. Inflation is not just a rise in prices. It is a redistribution mechanism. Over time, the The system learned how to stabilize itself through credibility rather than constraint. Independent central banks, inflation targets, and technical language created the appearance of neutrality. Monetary policy became something discussed in basis points and forecasts, distant from everyday life. Yet its consequences showed up everywhere. In housing affordability, in stock valuations, in the growing dependence on debt to sustain living standards. Debt, in this framework, is not a flaw. It is the connective tissue. Governments issue bonds to finance deficits. Banks create credit by lending against expectations of future income. Households borrow to bridge the gap between wages and costs. As long as growth continues and confidence holds, the structure appears stable. The moment growth slows or trust wavers, the system demands intervention. This is why crises in a fiat world follow a familiar script. Liquidity dries up, markets freeze. Authorities step in as lenders of last resort, expanding balance sheets to prevent collapse. Each rescue reinforces the belief that the system must be protected at all costs. Each intervention raises the stakes of the next one. Stability becomes dependent on ever larger acts of support. The deeper truth is that fiat money does not remove limits. It relocates them. Instead of running out of gold, societies risk running out of confidence. Instead of facing immediate collapse, they face slow erosion. Purchasing power declines. Inequality widens. Asset bubbles inflate. The system survives by pulling the future into the present. In this sense, 1971 did not end monetary discipline. It transformed it into something softer, more political, and far harder to challenge. Power no longer rests in vaults. It rests in institutions that decide when pain arrives, who feels it first, and how much of it can be postponed. Every monetary system creates winners and losers. The difference after 1971 was that the redistribution became quieter, more complex, and easier to deny. Without gold, value no longer moved through visible transfers. It moved through balance sheets, asset prices, and time. The biggest winner was the issuer of the reserve currency. Once the dollar was freed from gold, the United States gained something no empire before it had possessed: the ability to finance itself in its own currency without a natural stopping point. Trade deficits no longer required correction through lost reserves. They were absorbed by the world's demand for dollars. Foreign nations worked, exported, and saved, and the savings came back as purchases of U.S. debt. America consumed today and promised tomorrow. Financial institutions adapted next. In a world of expanding credit, scale and proximity mattered. Banks that could access central bank liquidity survived shocks that would have destroyed smaller players. Capital markets flourished. Leverage amplified returns during booms, and losses during busts were increasingly socialized through bailouts. Risk did not disappear. It was redistributed upward and outward. Asset owners became structural beneficiaries. Stocks, real estate, and financial instruments rose faster than wages because they absorbed newly created money first. For those already inside the system, inflation felt like growth. For those outside it, inflation felt like erosion. Two people could live in the same economy and experience entirely different realities. The losers were less visible but far more numerous. Savers discovered that safety no longer preserved value. Fixed incomes lost purchasing power year after year. Wages struggled to keep pace with living costs. Younger generations entered a world where housing, education, and security required levels of debt that previous generations never faced. The promise that work alone could guarantee stability weakened. Governments also learned a new habit. Borrowing became politically easier than taxation. The costs of policy choices could be deferred beyond election cycles. Debt expanded not because of irresponsibility alone, but because the system rewarded delay. The true bill would arrive later, diluted across time and populations that had no voice in the original decisions. This is the uncomfortable symmetry of the fiat era. It produced extraordinary wealth and extraordinary fragility at the same time. It lifted markets while hollowing certainty. It created abundance on screens while introducing anxiety into daily life. The redistribution was not a conspiracy. It was a structural outcome of money without an anchor. By the time these patterns became obvious, they were already embedded. The system no longer depended on fairness to survive. It depended on confidence. And confidence, once shaken, is far harder to restore than gold ever was. Once the dollar cut its last tie to gold, the rest of the world had little choice but to follow. A global system cannot operate on mixed rules. If the anchor floats, everything attached to it must float as well. One by one, major economies abandoned their own gold links. Money everywhere became fiat, and with that shift, confidence replaced convertibility as the foundation of global order. This is where the consequences moved beyond economics and into geopolitics. The dollar did not weaken after 1971. It consolidated. Oil trade was priced in dollars. International debt was issued in dollars. Global reserves were held in dollars. The United States no longer needed to export goods to sustain dominance. It exported currency and the legal, military, and financial infrastructure that made that currency unavoidable. Institutions emerged to manage this new order. The International Monetary Fund and the World Bank became lenders of last resort for nations caught in crisis. But their assistance came denominated in dollars and conditioned on policy reforms that aligned countries with the system. Monetary sovereignty narrowed. Domestic priorities were often subordinated to external stability. Confidence had rules, and those rules were written at the center. Crises became cyclical and synchronized. Latin America in the 1980s, Asia in the late 1990s, the global financial crisis of 2008. Each time, the prescription was similar: inject liquidity, stabilize markets, restore confidence. Each rescue prevented immediate collapse, but expanded the scale of the system that required rescuing. Fragility accumulated quietly. For developing nations, the cost was especially sharp. Borrowing in a foreign currency meant exposure to decisions made elsewhere. A rise in U.S. interest rates could trigger capital flight, currency devaluation, and recession thousands of miles away. Monetary policy in one country became destiny in another. The world ran on a single heartbeat. Even advanced economies became dependent. Growth models adjusted to cheap credit. Asset prices substituted for productivity gains. Political promises leaned on perpetual expansion. The idea of contraction became taboo because contraction in a confidence-based system risks cascading failure. By the early 21st century, the architecture was clear. The global economy no longer rested on production alone, or even trade alone. It rested on belief. Belief that debts could be rolled over, that central banks could intervene in time, that tomorrow's growth would validate today's promises. The system functioned not because it was unbreakable, but because everyone feared being the first to doubt it. This is the paradox born in 1971. A system powerful enough to bind the world together, yet fragile enough that it must be constantly reassured. Money survived, but meaning was outsourced to confidence. And confidence, unlike gold, cannot be stored in a vault. So what really died on that Sunday night in August 1971 was not money itself, but the boundary that once gave money meaning. Gold did not make societies virtuous. It made promises costly, and when that cost disappeared, the nature of decision-making changed everywhere, quietly and permanently. The world we live in now is not broken by accident. It is operating exactly as designed for a system built on confidence rather than constraint. Inflation that never fully goes away. Debt that is never truly paid down. Markets that must keep rising to justify the past. Governments that promise stability by borrowing from the future. None of this is a malfunction. It is the logic of money without an anchor. For a generation born after 1971, this feels normal. Prices rise. Assets inflate. Crises arrive and are patched with liquidity. The numbers get larger, but the story stays the same. Each cycle teaches people not to question the foundation, but to adapt to it. Save differently. Invest earlier. Take more risk just to stand still. Meaning shifts from preservation to participation. History, however, is unforgiving, with systems built entirely on belief. Rome clipped its coins. Revolutionary France printed promises. Weimar trusted paper over production. Each time, the reckoning did not arrive because people were foolish, but because confidence is finite. Once doubt spreads faster than reassurance. The system demands a reset. Nixon did not intend to create this world. He was trying to prevent an immediate collapse. In that sense, the decision worked. But it traded a visible crisis for a permanent condition, a global order that can only survive through expansion, intervention, and belief that tomorrow will always be larger than today. The strategic lesson is not to predict collapse on a schedule, it is to understand the terrain. When you know money is a story backed by power rather than metal, you stop mistaking numbers for value. You start asking different questions. Who controls the narrative? Who absorbs the cost? Who benefits from delay? The night money lost its meaning did not end history. It set the terms for the era we are still living through. And until those terms change, every surge of inflation, every debt crisis, every emergency rescue is not a surprise. It is an echo. If this reframed how you see money, share it with someone who still thinks the system is permanent, and stay with me. Understanding power is the first step toward not being surprised by it.